Welcome back. This is gonna be the video that goes over your company investing checklist. And in this video, we're gonna cover if you should or should not invest in a company, what are the fundamentals of a company, and we're gonna go over the fundamental red flag checklist. One of the big important fundamental things you need to know about a company is the macroeconomic fundamentals of the company, right? And this is like your unemployment rate, this is your supply and demand, this is the growth, inflation, as many other considerations, monetary policy that comes out from the federal government, international trade, is your company big enough to be overseas, right? So the way I break this down, unemployment, first of all, how many fucking people does your company have? How many people is your company supposed to have? That's an important factor, because if my Amazon was only staffing at 50%, I'd say, oh shit, there's some major issues going on at Amazon. Why are they not staffed to capacity? Why is people not wanting to work there, right? Supply and demand. Is there always a strong demand for your product? Do people want to buy it? Do you have the inventory, the supply for those people? Have you ever watched Shark Tank? What's the number one issue you hear about these small companies? We don't have inventory. We don't have the supply for the rapid demand that we just received. So that's an important piece of macroeconomic fundamentals for that company that those sharks are listening to. Okay, they don't have the supply for the demand. Growth. Do you want to invest in a company at $100 a stock this year, and in 10 years it's $110? Let me give you the short answer. Fuck no, you don't. You want to invest in a company that's going to grow over time and has the economic fundamentals to do so. Inflation. One thing we're dealing with strongly right now as I make this video is a rare occasion where we dealt with some very rapid inflation due to the COVID pandemic. Inflation affects companies. Look at small cap banks right now. Their backs are breaking because of the inflation rates, and this can also happen sector wide, as well as monetary, fiscal policy, and international trade. Do you think the Chinese tariffs were affecting Apple's company where all iPhones are made? You're damn fucking right it was. So all of these external policies and things that come from the government also need to be included to your macroeconomic fundamentals when you're doing your deep dive research, looking for those fundamental red flags. Baby, sound the alarms. So microeconomic data is what studies individuals and firms' allocation of like resources, production, exchange. But the way I kind of interpret that is like, you know, are we bringing in more than we're putting out? What's the overhead? What's the burnage of the company here, right? We got the gross revenue, but is our net income kind of, you know, what's the production rate here? Do we have that supply and demand, sort of macro into micro? So that's how I kind of take that. So microeconomics, very important when it comes down to production, exchange, consumption. Okay, so if you're looking, macroeconomic and microeconomic, I've never even heard these terms before, Max, so where do I find this? Best place, go to the company's websites, look up their earnings reports, look up their last year's earnings reports, break them down. You can do a keyword search, and there's also third-party companies that release big, strong fundamental reports on large cap companies that you can go onto Google and all these other free resources and pull them up yourself. So it's very important that if you're going to invest large amount of money into a company, I would say it would be best to do your own due diligence and do your own fundamental deep dive and really start looking for those fucking. When we're talking macroeconomics and we're talking fundamental red flags, where's one of the red flags? So you can get several red flags from this. Red flag if Amazon staffing drops dramatically. Supply and demand. It's good to have a strong demand, but not if you don't have the supply. And if you have the supply and there's no demand for your product, huge red flag right there, right? Growth, you know, like we talked about, the chart needs to go like this, not like this. Big red flag if you look at the last 5 years. Inflation, it could be a topic, it could not be a topic. Monetary and fiscal policy, these are things that you need to know. International trade. If China says, by the way, we're going to stop making all US fucking products, sound the alarms because Apple is going to shit the bed, right? So you got to look at these key things and understand some red flags you might get from them. Every quarter, every publicly traded company in the New York Stock Exchange has to release their earnings report, right? An earnings report covers things like profitability, revenue, assets, liabilities, growth, their price to earning ratios, the guidance and outlook for the future of that company. It's usually presented by the CEO, COO, someone on the top brass. So when we're dealing with the financial statements of a company, this is where you can start getting those key numbers that as a fundamental red flag you would want to stay away from. And I'm going to break down a few of them here for you. If you're looking for an earnings report, you can find them on the company's website. You can go to a website like earningwhispers.com, Market Watch, or any of these big stock market related news companies, and they will most likely have the earnings reports. You will get key breakdowns and you'll get notifications from your brokers as well. So to find an earnings report is very simple. Understanding them is another thing. So let's break into these and see what we can cover. First big fucking fundamental red flag for me when looking at a company's earning report, and this is the first one that should be right there smack dab on the front page. Is the company profitable? Or is the earnings per share below zero? If the company's not profitable, I probably don't want to invest in this company long term. For me, it is so important to see profit, to see margins, to see cash growth. And that is one thing that I look for first. Always when I'm checking the financials of a company is the company profitable, or is that a fundamental red flag? Sound the alarms. The next thing I like to look at is the company's revenue. Revenue is very important. Now, this is not profitability or net income. We're talking about total revenue. This brings us back to demand, right? Is there a demand for the product that's creating enough revenue for sustainability? Revenue is such a key factor when we're talking about financials. I want to see revenue growth year over year, month over month. You want to see a company that has started with $1 million in revenue to 3 to 10 to 20 to 50 to 100 to $1 billion. That's the revenue kind of equity curve we're looking for. So if you see a revenue is a rocky, bumpy road and it starts downtrending at all year over year, sound the fucking alarms, baby. That's probably that's a fundamental red flag. Assets and liabilities. This is an important piece of a company's financial statements that you need to understand. If you don't understand assets and liabilities, let's rewind a second. I think you should read Rich Dad, Poor Dad by Robert Kiyosaki. It's the original book and the book that I recommend for anyone who's really trying to understand assets, liabilities, and creating passive income from themselves, whether it be through real estate, stocks, or any other additional sources of income. So I would check that book out and it would definitely start breaking down that assets versus liabilities for you. But when we're talking about fundamental red flags and the assets and liabilities of a company, right? We want a company that owns more assets than liabilities, right? Liabilities are cash burnage. They're costing the company funds. They are a liability. They are a risk. Whereas assets are a cash producing item, or a item that could be like a commercial building that's paid off, a nice piece of real estate. It could be something like machinery inside of a warehouse that's paid off. These become assets for the company. That's why when you see a company that's liquidated, they can also liquidate their assets and make a shit ton of cash before going out of business. So assets versus liabilities. I want to see strong assets and I want to see little fucking liabilities. So the third one, like the third, growth potentials and guidance, right? Like earnings reports. This is more of a fundamental and not a financial, but like the outlook of the company, they tell you like, hey, we think for quarter four, it's quarter two right now, but we think for quarter four, we're going to crush revenue and we're going to raise our guidance and we think we're going to be sold out for the next 2 years. And as an investor, I hear that and I'm like, oh, hell yeah. Like, that's awesome. That's a fundamental green flag, baby. Sound the alarms. But if you hear them saying, hey, listen, we're going to cut our revenue guidance for the next 2 quarters because we're uncertain, we're unsure of where the future is going to be. We don't like the way the economy looks, whatever. I hear that as an investor, and now I sound the fundamental red flags. That's an alarm, right? When you're talking about outlook and guidance, you want a company who's going to say, yes, we're on the trajectory that our shareholders want, and we're not on the trajectory that the shareholders don't want. When we're looking for quick fundamentals of a company, there's some rule of thumbs here. So a company that is said to have tons of cash and little debt, that's kind of a quick rule of thumb for anyone. Hey, this company is cash strapped and has little debt, like Warren Buffett's Berkshire Hathaway, Apple, like these top companies. They have hundreds of millions in cash and they have very little debts. And the debts that they do use, they use to their benefits. So when you have companies like that, that's like the quick rule of thumb of like cash strong, debt low. Okay, I can start digging more into the fundamentals of this company because it has that initial attraction and appeal. Companies that have that, they beg the question, can this company survive a recession, a depression? Can this company survive crazy market fluctuations, right? So over in 2022 last year, we noticed crazy market fluctuations to the downside. This crushed a ton of stocks. This crushed a lot of small caps. And now in 2023, what are we seeing? A massive explosion of everything in the NASDAQ. Semiconductors and tech have exploded. The NASDAQ is up over 35% in the first 2 quarters of this year. So those companies, NVIDIA, AMD, Apple, Google, Facebook, Netflix, right? All the big ones, those companies had more than enough to handle that market fluctuation to the point where they're thriving now when we come out of it, when we enter into that long-term growth and stabilization that you're looking for when you're checking for your fundamental red flags. So a company that has all of those profitabilities, all of those revenues, those assets, those macroeconomics, all of it, they're able to survive recessions. They're able to survive market fluctuations. They have all of the quick yes, yes, yes. And those long terms are what's going to make you a long-term, profitable, successful investor. So some fundamental ratios that are important to know, right? Debt to equity, the quick ratio, the financial leverage. The PE ratio to me is like the quick glance most important because it's right at the front page of every broker, and the DuPont, right? So if you take a look down here, you'll see the debt to equity ratio right here. This is the formula needed for that. So when we're looking at debt to total liabilities over total shareholders equity, when we're looking at the quick ratio, here's the formula for that. The quick assets on top of the current liabilities. Remember, we talked about quick assets, cash producing, good paid off items, liabilities causing the company to spend funds. So that's the good ratio for the quick ratio for that. The degree of financial leverage. It's important to know how much leverage a company has. If a company needed to leverage funds, if you take a look at this formula here, you'll see the degree of financial leverage is a very easy and simple formula, but it's important to know what a company has. The PE ratio. So the PE ratio, not physical exercise, you look dumbass, but the price/earnings ratio per share, right? So the market value per share, if you look up here in the corner, the market value per share over the earnings per share. The EPS is usually the first number you see when an earnings report is released every quarter. The PE ratio, you have what the company said they were going to make, that's the expectations of Wall Street, and what they actually made. So if they beat that number, that's where you'll see that, oh, we beat that number, so we're actually a lot stronger than we initially thought or projected for the previous quarter. P ratio is very simple and very easy for an investor to understand and to look at, and I think everyone should have that number in their mind when they go to look for a fundamental red flag. Lastly is the DuPont. DuPont analysis is the net profit margin, if you take a look up here, times AT times EM. So what is that? That is the net profit margin over the net income and revenue with the asset turnover and a bunch of other good mathematical formulas here that is above my pay grade. So I'm just going to put it up on the screen for you and I'm going to move the fuck on, baby. Now that I've covered a lot of these good fundamental red flags, it's important that you also know the most important thing about being an investor and being a trader. And that is your own fundamental red flags, right? So as an investor and as a trader, we have to know ourselves more than anything because trading is 90% doing nothing and then 10% taking accountability for yourself while you're actively investing or trading. So some important things you need to consider when you're looking for long-term growth and long-term investments, whatever it may be, is your own fundamental red flags. Now, what is that? That could be as simple as not understanding the investment. You don't do any due diligence. You just, Joe Smo calls you and says, this stock is awesome, you should buy it. That's not okay. So that's a fundamental red flag. Another thing that you should not do is fall in love with a company. I use a term saying don't marry a stock. A stock is not going to be in bed with you at night. So at the end of the day, don't fall in love with these companies. You need to have risk management in place and understand yourself. Lack of patience, patience, patience. We always say patience pays. Patience, if you're a long-term investor, I know tons of people that run multi 8, 9 figure funds and they don't even look at the fund but every 6 months. How do they have practiced and been coached that level of patience? But we're sitting here looking at our phones every 30 fucking seconds where we can't even hold a conversation during market hours. You have to be patient. You have to learn how to set it, forget it, and walk away. Another big fundamental red flag for yourself is investment turnover, right? So you're in an investment for 2 months and you're like, I only made 1%. I'm out of there. I'm going to look for something hotter and better. And you just keep turning over your equity instead of letting it grow over time. That's a big red flag. You need to be patient when you're investing. When you understand the fundamental checklist and it works, you need to let that funds grow. If you try and attempt to time the market, you'll never, ever enter the market, right? Warren Buffett said it's not about timing the market. It's about time in market. So it doesn't matter when you join. If there's a recession, I would say that's the best time to buy stocks. If you have cash loaded, buy stocks during a down year and then let it go forever, because that down turnover in the long term will most likely, if it's in the SP 500, be successful. So don't ever try to attempt to time the market. Just start now. You're never going to get even if you don't understand those first 5 fundamentals for yourself. So if you don't start practicing the little things, then you're never going to be able to nail the big things. Remember that. A lot of people join the stock market, and this is a big fundamental red flag. When I first started investing, I picked 55 stocks that I liked in multiple sectors for diversification within my portfolio. Some people say diversification doesn't work. You could just literally buy the S&P 500, but guess what? That means you're buying fractional shares of 500 different companies with weight on different sides. You're diversified. So any sort of diversification, depending on how you observe and practice diversification, is key. So I think you should diversify. And out of my 55 original, the VU was one of them, which is the SP 500, the total bond market, and the total stock market. So I bought every fucking company and every bond. So you need to learn how to diversify. And most importantly, the last thing you need to know, a fundamental red flag for yourself, is how to control your emotions, right? Fear, greed, hope. We cover this so many times, yet everyone still does it. It's going to happen to you again. It's going to happen to me again, even as I sit here and fucking preach it. You got to learn how to control your emotions. You got to learn how to diversify. You got to learn how to do the due diligence. You have to understand all of these fundamental red flags when it comes to macro and microeconomic data. You have to understand earnings ratios and what makes a company a strong fundamental choice for you, and not a fundamental red flag that you're putting your equity at risk. You want to know what's not a red flag? Come on over to Max Options Trading and check out our 7-day free trial, where if you need help understanding anything when it comes to stock market and stock market options, we're here to help educate you. We have a 7-day free trial, and that is, to me, one big green flag.